Good afternoon, ladies and gentlemen, and welcome to a panel that I've been looking forward to all day. The World Outlook panel, taking a look at geopolitics, investments, where perhaps you want to have your money or maybe you want to avoid having your money in the months, years ahead. I'm Robert Levy from Border Gold precious metal dealer here in Canada, located just outside of Vancouver, British Columbia. But joining me on the stage here to my left is John Kaiser of Kaiser Research. Next to John, Danielle Park, portfolio manager and partner at Venable Park Investment Counsel. And as well, who we just heard from, Grant Williams, senior advisor to Vulpes Investment Management and author of the newsletter, Things That Make You Go, And we're going to start off with a very broad question and perhaps take maybe a bit of a macro look, and we can narrow in off of that. But here we go. Starting with the TSX in Canada, it's slumping. Headline after the close today is TSX is on its longest losing streak in a year. You look to Europe, where you've got the threat of deflation, perhaps triple-dip recession. You look at the emerging market, and you only really see emerging market growth when there's an optimism around the world economy, which seems to be fading. So right now, and John, we'll start with you, is the U.S., the U.S. dollar, U.S. investments the only game in town?
Is it the only game in town? The U.S. equity markets are really poised for potential significant retrenchment. Bonds are at very close to par, so very low yields. There really is no place to hide, even in the U.S. economy, unless you're hoping to that these technology things go higher yet.
And Danielle?
So the fact that we think that the, a 4% decline in the TSX in the past couple of months is considered a big front page story just gives you a sense of how crazy the past 2 years have been, how incredibly low volatility has been. You know, a 100-point, 200-point swing. People forget that we're talking about 600 and 700-point declines during bear markets. You know, when the selling really kicks in, that's the kind of volatility that you could see. And I think that the TSX deserves to have its comeuppance. Unlike Grant, who I agree with so much of what you were saying, Grant, but I actually do think we're in a secular bear market in real terms, have been since 2000. We've made some nominal highs on the S&P and the TSX, but anyone who's a Canadian investor knows we're right back basically where we were in the summer of 2008 on the TSX, and yet brokers are insisting this is progress. So we're essentially in this, we're, I think, setting up for the third next cyclical decline. Once everyone realizes that the Federal Reserve has been playing a game of bluff and they actually don't control the business cycle, no matter what they've done to obviate it the past 15 years, we've still had two massive declines in the stock market. They maybe have shortened the duration of the downturn in the economy. But in terms of the stock market, they haven't been able to stop the bear markets from intervening. So I think that U.S. S&P is a freak show. I think Canadian stocks, large caps, freak show. Now, good news is the venture is already back basically very near the lows of 2009, the cyclical lows that were hit in the recession of 2009. I think that's where the rest of the stuff may well be headed. And the biggest risk right now is in the dividend-paying stuff that everyone's bought thinking it was conservative. It's, I think, the antithesis of conservative at the minute. So I guess I'll stop there for now.
Thank you. And Grant, to you.
Excuse me. There's a couple of things I'd say. First of all, when you talk about is the U.S. equity market the only game in town, I think a big problem is people have been conditioned over the last 20, 25 years to look at equities and bonds and make it as simple as that. And they rotate out of U.S. equities into European equities or into Japanese equities and hedge the yen and do all these things. The real value now is not in the equity markets that everybody sits at home clicking their mouse and buying through TD Ameritrade, because the markets are so crowded that these things have been driven up. You saw that chart ahead of the volumes on these stock exchanges. There is real value if you can get into the weeds and look for private credit and private deals. Farmland there's advantages, but these are not things that you can do as an individual investor, and that's the problem. People are funneled into the same places and end up chasing everybody else and end up having to buy overpriced assets. The other thing I would say, and it's something that I've heard talked about a few times today, and that's the strength of the dollar. And I think it's important to understand that when people talk about the strength of the dollar, what they're actually talking about at the moment is weakness in other currencies. The dollar is the inverse of weakness in the yen, of weakness in the euro, of weakness in the pound ahead of the Scottish referendum. So while this with strengthening dollar has frightened a lot of people, particularly in the precious metal space over the last couple of months, and it is it's a very, very strong run, that can reverse very, very quickly, and then things turn around for the good. So there are the two things that I would add to that.
Well, to leave it with you, Grant, can the slump in the dollar almost not be twofold from the sense that we're looking at struggling commodity prices? There's talk in the U.S. now, the exit of the taper and interest rates now going higher in the spring of 2015. So is there also reason to be bullish on the U.S. dollar?
The problem is it's the last thing that the Federal Reserve want or need is a strong dollar. Everybody needs a weak currency right now, and that's the game you've been seeing. This currency war that you keep hearing about is very, very real, and every country in the world really needs a weaker currency. So for the US, they're doing everything they can to keep the dollar down. I don't think you're going to see a rise in interest rates anytime soon. The taper ends next month, and these guys have already tapered several times. They tapered at the end of QE1, the market fell 15%. They tapered at the end of QE2, the market fell a similar amount. They tapered at the end of Operation Twist, the market didn't fall quite as drastically, but it fell. So we've had 3 tapers. People are talking about this because they've given it a catchy name this time around. People think it's the first time they've tried this. They've tried it 3 times and failed spectacularly 3 times. So people should be very, very aware that with markets at all-time highs on massively reduced volumes, if we do see the same reaction when the taper ends next month, it's going to be a very, very crowded exit indeed. And for my mind, it makes sense to not really wait for the outcome and be in these markets. To my mind, you should be out of these markets when the taper finishes and just see how the dust settles, because the potential downside could be enormous.
And Danielle, do you want to comment on that?
Yeah, well, actually, the rising U.S. dollar was one of the factors that we were accurate in tracking or thinking was a likely secular shift out of, first of all, the falling dollar from 2000, the peak when the Canadian dollar, when the U.S. dollar was very strong, all the way into the bottom of 2008. And then I think a secular shift began then, and that you're having a rising dollar relative to these other places' currencies and debt levels, which are all in much worse shape. It's all the ugliest of the ugly, I'll grant you, and there's too much debt everywhere. But I think we're in a long and sustained upcycle in the U.S. dollar. Now, I agree, things can turn on a dime, and with the amount of leverage in the world today, that straight lines up revert to straight lines down very quickly. There's a ton of risk in pretty much everything at the moment, but I do think that the U.S. dollar will receive inflows here for a while longer, and that's going to continue to be negative for things like the precious metals and commodities, for S&P earnings, because S&P earnings are at record highs and everyone's forecasting nothing could possibly go wrong. I think that that's going to be a headwind for that trend. So I agree that, pulling back from these things that have gone up an undue amount with the QE nonsense of the past 2 years, liquidity is key. Now, where do you find liquidity? I think you find it in cash-like instruments, in the highest credit qualities that you can find on a short-term perspective. And for Canadian investors, the U.S. dollar, we made like 25% in 2008 as everything fell, holding the U.S. dollar for Canadian investors. So it is a place to park. I'm not saying you fall in love and you stay there forever. You don't do that with anything. But I think in this type of climate, it's a place to get capital gains without having to buy equities and to have one of the most liquid assets in the world.
And John, how do you feel about that?
Well, I think the U.S. markets are unfortunately going to surprise us on the upside. It is such an obvious forecast that it should go down 10-15% after 4 or 5 years of quantitative easing. But what people are forgetting is that this is being done to sort of demonstrate that the U.S. economy can go on without quantitative easing. And the expectation is that it won't. But if it doesn't start to tank, Main Street hasn't been part of this. The participation has been the upper echelons of the economic spectrum. Main Street's sitting on $9 trillion of bank deposits that have been earning nothing, and the threat of raising interest rates very slowly doesn't impress them. If this market doesn't collapse in the next 3 months, it's going to go exponential on the upside. And that's the big shock, because people are going to see it not going down as validation that the patient can get off the bed and start walking without the IV drip. And I think that's the negative thing hanging over the junior sector. And the gold sector is the possibility that, hey, all this stuff worked, and we got something like 1999 where everything was overpriced and doomed for a fall, and then it went exponential until the flame out in March 2000.
Any comments from the panel, or do we have any
I think this disconnect between the economy and the stock market is critical to comprehend. I don't think that the U.S. economy has to, collapse. I just think that the stock market probably has to collapse at some point here, because it's so in a world of its own dreaming that there's no connection between investment thesis and what's going on in the real economy or earnings. And it's like interesting, in 2001, we didn't actually have a classic recession in Canada. We fared better, but we still had a 50% drop in the stock market. The same with 2008. Everyone lauded Canada for having a better fiscal balance sheet, et cetera, going into the downturn, but we still had a 50% collapse in our stock market. So I think you need to keep in mind, what is the point of the conversation? The point of the conversation, if you're looking after assets, is what things are going to go up and what things are going to go down. Not, falling in love with long-term cycle views and esoteric discussions, which I love over dinner, but if I'm looking after money, I have to be concerned about what's liquid, what's likely to stay at or go up in value if everything else begins to go down. And I think that's where people have to be focused today. Capital preservation, liquidity, those things.
Excuse me, I'd add one more thing. I think John hit the nail on the head there where he said, if the market doesn't collapse, it could go exponential. And for me, the risk reward of that trade terrifies me. I don't want to be in something that if it doesn't collapse, it's going to go exponential. Because if it collapses, if you're going to be a smart investor, the one thing, and I would urge you all to understand this, the one thing you must avoid are big drawdowns in your portfolio, because they are the things that it's impossible to get back from. If you lose 5% of your portfolio, you have to make 7 or 8% to get back to where you were. If you have a 75% downdraft, and they've happened many times, you have to make over 350% to get back to even. So one of the things that every smart investor does is to avoid those big drawdowns. And that's why if the risk is too high that we may collapse, I'd rather miss the collapse and miss the first part of this exponential rise to understand that, okay, I can see why this thing's going to go exponential now, and I'll take 50% of that exponential rise and stay out of the market when I feel it might collapse.
That leads nicely, I think, into the next question, because as many analysts, market commentators have been talking about, there's almost this dichotomy in the markets between the story that perhaps the stock market in the U.S. is telling and then what the bond market is telling. If we have stock market that's looking for growth long-term in the U.S. economy, very optimistic, but then in the bond market, you look out longer dated, the 30-year U.S. government bond, and it's almost priced for low inflation, low growth. So which story gives here in this scenario? Which one is it would you stick with? And maybe, John, we'll start with you again. Or if you want, we could go to Grant.
Yeah, let's go to Grant.
We'll start with Grant.
Thanks, John. What we're seeing now is what happens when you insert an outside agent into a normally functioning human market situation, and that's the Federal Reserve, negative interest rates, quantitative easing. Things have been disrupted. I mean, I work with guys all around the world who've been in this business for 30, 40, 50 years, some of them, and nobody, and I mean nobody, truly understands what's going on now, because you have this outside agent. So everything is priced in a way that normal experience would dictate it shouldn't be there, and yet you have to play these markets as you find them. So we are seeing extraordinary performances in the S&P, but if you break out things like algorithmic trading, you break out high frequency trading, you break out ETF trackers, you'll find a completely different market underneath that. In the bond market, when you've got France, a country which is borderline bankrupt, and I'm trying to be polite to the French here because I'm in Canada, who can borrow money for less than they have ever been able to do in 350 years of recorded history, something is wrong. If you can get the same yield on a Spanish 10-year bond as you can get on a US Treasury 10-year bond, something is wrong. And these lights are flashing loud and clear. And if you look back through history, the day before anything major happened, go back to December the 6th, 1941, Go back to the day before my friend Gavrilo Princip shot Archduke Ferdinand in Sarajevo. The day before these things happened, 99.9% of the people said everything was fine and nothing was going to happen. The day after it, everybody knew what was going to go wrong. And there are enough warning light signs flashing in these markets for me as an investor to think that the risk-reward right here is just not skewed in my favor. And I tend to stay out of markets when they're like that.
Danielle?
Yeah, I think the reason that North American yields have moved lower again is relatively they are still the juiciest yields on the planet pretty much at the moment of all the developed markets. Think about, the Japanese yen and the lack of yield that's been available in Japanese bonds in the past few years, and the Japanese yen went higher. At some point, people are looking for a currency park, a liquid place when they're concerned about valuations in so many other markets. So they're going to buy things like 10-year treasuries or shorter bonds in North America because yields are attractive and currency's liquid. So I think that it just reflects this deflationary trend. I think it's demographic and debt, and I think we're going to get a Jubilee event at some point which will finally knock off zeros. And we should have had that in 2008. We didn't. They were piled onto the public purse. But I think that that's why there's just no good growth story to look at. People that are doing an investment thesis are looking around going, well, that's screwed up. Well, that's screwed up. Well, that makes no sense. And believe me, not everybody runs around like a crazy person buying everything just because it's going up. I know that's what the media, oh, you missed out, you're out. And it's like this panic, well, I better buy crap just because everybody else is buying crap. You don't have to buy crap. And so you can actually make your discipline and wait for the rule set to come into play. That's the discipline that differentiates people who are successful over full market cycles and people who are just running around with their head cut off, making every mistake after everybody else. So it really requires a lot of discipline and care. And if it doesn't make mathematical sense, it shouldn't be something people put capital into. So I think that's a long story short. I think bonds in North America, I don't think rates are likely to spike fast. I think they're a play for security of currency perception-wise relative in the world, and that they may indeed be a decent place to park for a while longer. But again, the yield curve is flattening in the U.S. too, between 5 and 30, which is also a portend, I think, to this more difficult environment we're going into for capital markets. So that kind of makes sense to me.
Can we assume then that you didn't buy Alibaba for your clients at a 60 times earnings to share?
No, I didn't come up the wagon in a bubble, as my dad would say.
Can I just add one thing? Sorry, John, I don't know if I'm interrupting you. I don't mean to. What I would say is, and Danielle's absolutely right, but everybody has been forced to accept this new world that we're now in. And so you have this crazy situation where in 2007, right before the financial crisis, if you had $10 million invested in US treasuries, 5-year treasuries, you would take home $480,000 of interest, risk-free every year. And people could live on that. The same deal today, you have $10 million in 5-year treasuries, you're taking home $43,000. That's the difference in the world we live in today, and that's the adjustment that people have to make. And so when people are talking about how treasuries are a safe place and they're liquid, that's all true. The question is, are you being rewarded adequately? And the simple answer is you're not, because of the interference of outside agencies. So this is why high yield bonds are trading at all-time highs, because people are starved of yield. And this is the game that's very overtly being played. Central banks need that. I talked about this largest pool of untapped capital savings. They need people to be frightened of putting their money in treasuries. They don't want them putting all their money there safe. They need it out in the economy, multiplying and having a positive effect on the growth in the economy. But people are buying German bonds and paying for the benefit of owning 2-year German government bonds. Now, if the EU goes, guess who's carrying the bucket? That's Germany. And yet people are willing to pay the German government, half a basis point to lend them money. So the world is very, very screwed up right now. It's a tough place to get a handle on. It's not for the faint of heart. And you really need to try and look back to see what the world looked like before all this happened, and then make the adjustments to decide whether the investments you're looking at today actually make sense in the real world, not just the world we live in at the moment.
Your question sort of touched on the nature of the growth of the U.S. economy. And I think that is the big unknown. What is the nature of the growth going forward? Now, since the meltdown in 2008, there has been only one quarter where mortgages actually increased in the United States. It has been a deleveraging period during every single quarter. At the same time, the net equity that American households have in real estate has recovered 2/3 of what it lost from the peak in 2006. And yet, real estate in general has recovered only half. So we have a skewed economy where a certain segment has done extremely well. My own home lost 50% of its peak value, but now it is 50% higher than its peak value. I live in the Bay Area, and there have been tremendous inflows of capital. I understand it's a couple $1 trillion that the Chinese have spirited out of China into the West, and of course real estate is one of their preferred investment targets because they're not allowed to buy productive assets. We've had a tremendous real estate recovery in specialized sectors, but what has been missing is a credit expansion that affects Main Street. And what we have to watch for is, will the banks, after not really lending for 5-6 years, start to lend to the ordinary people? Because that's what's needed to kick off the virtuous circle of business not wasting its money buying back its own shares, but putting it into the ground to develop new productive capacity, because they see consumption growth emerging amongst the younger people who are right now the ones not getting very good jobs in the kind of economy that has been created since the crash.
And that's a story I think that's true for the U.S., and I think it's one that's particularly true for Europe. And I mean, just to shift gears and talk about Europe for a second, is there anything in Europe? Do you just avoid Europe, stay out of Europe altogether? What do you see for the euro? And Mario Draghi's most often quoted words about doing whatever it takes to preserve the euro. Is there some steps that they can take in Europe that might say, okay, wait a minute, now this region looks interesting again? And maybe going down to you at the end, Grant.
Me, yeah. As the only European here, I guess. Look, Europe is an incredibly difficult place to understand unless you've lived there. And I think what you said is absolutely right. You know, that phrase of Draghi's, that promise to do whatever it takes. The day before that was one of those days I was talking about. You know, the wheels were about to fall off in Europe. That whole project was about to disintegrate until Draghi came out and said that. But Europe is a story that's not finished yet, and there are so many things that can go wrong there. You know, right now, if you look at Italy, there's a country that is a disaster waiting to happen, and if it happens, it's going to happen on a scale that's impossible for the EU to bail out. Now, there's all kinds of sticking plasters being put over this, but an Italian debt default, which is absolutely not beyond the realms of possibility, would be multiples of Greece, which was the largest sovereign bond default in history. An Italian bond default is not something that can be covered by the EU. That could go wrong. France's economy is deteriorating rapidly. That's of a magnitude even greater than Italy. So there are all kinds of things that could go wrong. You have deflation in Germany, which is essentially, they're not an outright deflation, but you have massively decreasing inflation. And again, when you have such a debt burden, you have to have inflation to try and inflate that debt away. Deflation will cripple you if you have that kind of debt burden. So Europe is currently being held together by Draghi's promise. And his second promise a few months ago, I forget the words of that one, it wasn't quite as punchy, where he promised that not only will they do whatever it takes, but you haven't seen anything yet, or something along those lines. But at some point, you know, this is a confidence game. What Draghi said shored up people's confidence. It shored up confidence in the European zone. It shored up the confidence of investors. If you lose that confidence, it doesn't matter what you say. You're going to have to act, and you know you have a divided council. You have the Germans, who are very hawkish on one hand. The southern states of Europe are very dovish. So you could see a split along those lines. You could see the southern states leave because they need to devalue their currencies. There are any number of ways that the Eurozone project can go horribly wrong. And I've yet to come up with a way, short of some kind of economic miracle out somewhere, that it can actually end happily, unless they can hold it together long enough for things to return to normal on their own. I just don't think they can. Well,
I love Europe. I think it's really important to remember that these our cycles and this too shall pass, and maybe in a war, I think is what you were saying, Grant, and I hope not for everyone's sake. But I think that the mistake we humans tend to make is to see the present as a perpetual condition. And I think that I've been saying this simplistically for years, but I believe we just need to knock off zeros all over the place, because debt which can't be paid won't be, and that which can't continue won't. And that's the two things I know for sure. So I love Europe. Do I want to put capital there right now? No, because I don't like the euro. I think it's falling. Now you could try and pick equities and hedge currency, and it sounds simple, but it's not. The other thing I think is that the correlation between global markets, this diversity idea is nice, and we learned it in the textbooks, but in reality, in the conditions we've been in, we have this remarkable correlation in the major indices of all over the world. It's partly a function of globalization and financial institutions being everywhere, and the algo traders, going at it every day. So there's a lot of correlation. So the equities and high yield debt, it's the same mess at the moment, pretty much everywhere in the world. I would need it to come off something like 50% for me to kind of feel like it's worthy of capital today. I think we might get that, though. I think it could come faster than people think possible. Think of how quickly things collapsed in 08. We had a peak in October of 07 in America, June of 08 with Canada and the commodity cycle, and by November, between June and November, the thing had fallen 50%. Okay, that's a function of the margin and leverage and intricacy correlations of all these markets. So I'm thinking if that could happen really quick, or it could take another 2 years, but it's going to happen. And I think that you just sort of prepare yourself for that and keep your mind open. Don't ever think that what's happening right now is permanent and it's never going to change.
I think in 2007, we had already seen the cracks in the edifice, and what puzzled me was that nobody seemed to care, and that we went as far as we did before it all did fall apart in mid-2008. I don't think we've seen similar cracks yet, so I don't think we're vulnerable to a massive collapse like before. With regard to Europe, what worries me about Europe is that Germany, which was the victim of externally imposed austerity back in the 30s, turned into one of the most horrific right-wing nationalistic nations in the history of the world. And it's kind of ironic that right now they are imposing the austerity on everybody else, and we see Europe, that the conditions fostering the rise of extreme nationalist right-wing parties, who, of course, Europe is full of immigrants from Africa and the Middle East, and they are now the obvious target for the hostility. I'm worried about Europe because the policies that they have taken is turning it into a pressure cooker that will result in the disintegration of the Eurozone and the descent of all these population clusters into kind of what Yugoslavia turned into when it all fell apart.
I think we have time for one final question, and maybe 30 seconds, 45 seconds to talk about it, but maybe it's a depressed economic or financial environment, somewhere you want to park your money, or maybe it's somewhere you're pretty optimistic about, but what's one asset or a sector or what have you? What are you maybe optimistic on, or what are you going to in the months ahead? Gold, U.S. dollar, blue chips in the U.S., Danielle? No, okay.
No. I'm pretty much, whatever we were going to buy, we bought. So we've pared back. We don't hold equities at the moment. We have high quality, short duration, targeted specific bonds, U.S. dollars, Canadian cash. I don't know about gold. Gold didn't hold up really well in the 08 sell-off. It might if we go to some kind of a new standard where we correlate back with something hard. I could see there being a new bullish story for gold. I think it became heavily overinvested in the hype and pomp and circumstance of the credit bubble and everyone thinking everything was going to go up indefinitely. We'll see. I at the moment, I'm totally agnostic to see. I mean, it's still a downtrend at the moment, but that could change too.
For me, gold is something that I talk about a lot when I travel around the world, and I think there's a huge distinction that needs to be made when you talk about gold, and that's investing in gold and people who trade gold. What we saw in 2011 as gold ran up to $1,900, that was traders. That was people coming in that figured, I'm going to buy this at $1,900, I'm going to sell it at $2,500. I think if you own gold, you don't own it because you want to sell it. You own it because you want it there. I call it the insurance policy. Depending on how unsure you are about how this thing turns out, if you're 5% unsure that we have a bad outcome, you should have 5% of your money in gold. If you're 10% unsure, you should have 10% of your money in gold. And that's not to watch the price every day, but that's to have it there if the wheels fall off. Because if the wheels fall off, it will protect you. Right now, I would have a healthy allocation to cash, because at these levels on things like equities and bonds, the opportunity cost to holding cash, okay, in real terms, you might be losing a little bit of money, but I'd rather hold cash for 6 months and maybe give up, be guaranteed to give up 1%, but give myself an option to pick things up down 30, 40, 50% if we do see this correction that we know is potentially going to happen. If it doesn't happen and I can reassess in 6 months, okay, I've given up 1% guaranteed, and I may have missed out on some further rallies in equity markets, but I'm okay being out of equity markets at all-time highs. I'm okay with that, and I don't think people should be frightened to be in cash for periods of time when there's uncertainty around. Other than that, farmland still around the world, but again, these are not investments you can do from your couch on your iPad. But there are places you can go where you can find yield. It's generally in private markets, but it's out there. It just requires boots on the ground and digging in the weeds and finding these great companies that are starved of capital and will pay you very handsomely for lending to them.
And John, the last word to you.
I would put my capital into just two categories. One is cash, where if we get into another big meltdown and a deflationary cycle, you have the powder to buy all kinds of very depressed assets. But even better, when the purchasing power of your cash goes up, it is not taxed. If we get into an inflationary situation and you have gold and stuff like that, well, it'll go up, but the gains will be taxed and you're not going to be really much better off. The other group I would put it in is right now my favorite sector, the junior resource sector. Yes, they may get one more haircut before the end of the year, but you can already identify very good value amongst the survivors, both at the exploration end and at the development end. I'm not so sure yet about touching the miners at this stage, because they would get crunched in the bigger downdraft. But if we get into an expansion, markets going higher, and even inflation coming into the system, the little juniors are extremely leveraged to move on the upside, and I would still have, say, 80% of my capital parked in cash, so that when I know that the proper trend and engine is in place, I can shift more of that into this. And in a sense, the American economy, the Main Street is like that. All this cash sitting in their deposits, held by households that have no exposure to the market, is this huge potential wall of cash that could move into the sector and move it on the upside. And I think if it does move on the upside, we will see a turnaround of interest in this little micro niche sector.
Thank you. And ladies and gentlemen, thank you for sticking with us to the end of the day. And one time, thank you to our panel as well.